In this lecture we will go over a few different ways to trigger a trade after you already have built the correct context for a high-quality trade opportunity. I feel the need to emphasize once again that these trade triggers I will show you will not work by themselves. They only work if you use them in the correct context, otherwise trading would be a lot easier than what it actually is. I talk to many traders that are stubborn to understand this idea. They only want a setup or a way to get in and out of the market as quickly as possible. I guess all traders want that, especially the ones that are in the beginning of their careers, but it's necessary to understand that what traders want does not have anything to do with how the market actually works. In other words, just because you want something, it does not mean that you can make it happen in the exact way you wish. In reality, you have to find the intersection between what you want and what reality allows you to do in a way that this exercise becomes sustainable across time, and that's certainly a challenge. The way professional traders achieve this point of equilibrium is by employing setups only when they find themselves inside the correct context. It's important also that setups don't become arbitrary. There must be an underlying logic for us to really trust them. However, even after learning and understanding what I'm saying here, you will still have the will to forget it and to just use the simple setups. That's natural because we all want to make our lives easier. That's built into our biology and has been for a long time. It's actually one of the reasons we survived as a species. What you have to understand is that there are several different situations in modern life where we have to fight these primal impulses if we want to succeed. Let me warn you right now that if you decide to use these setups without analyzing the market first and without building the correct context, you will absolutely fail as a trader. It might work here and there, but in the overall picture you will be setting yourself up for failure. I hope you really listen to what I'm trying to say here because this is meant to help you in the best way possible. There are basically two fundamental ways of triggering a trade. One is opening trades at the very open value of a specific candle, and the second is opening trades while a specific candle is forming. The first method is more appropriate for beginner and intermediate students because it's just easier, but it has the disadvantage of being less precise. The second method is usually employed by advanced traders. It's more difficult, but it can be as precise as it ever gets. In both methods you need to pay attention to how candles behave in the levels that you identified with your context. Let's imagine, for simplicity's sake, that you identified a line that represents a level in which buyers seem to be present and willing to appear again in the chart. The first thing that is interesting to notice is if price is going to respect this line. We can tell this is happening when price touches the line but does not violate it. If price is actually going to respect such level, it will generate a momentary stop of some sort. Momentary stops usually generate inside candles in the chart or at least candles that do not advance price too much. An inside candle is a candle that is completely constrained inside the range of the immediately previous candle. This is another sign that our buyers are still holding and willing to help us. It's important to notice that the inside candle can form a second touch to the line in our example. That would be even better evidence in agreement with our trade idea. This is the moment where the majority of traders will decide that it is time to open a trade, then they will choose between the two fundamental methods of doing that. You could wait for the next candle to open, or you can try to place a buy order at the line with the expectation that price will touch it a third time. This is mere speculation of course, and it might not happen at all, but if it does, it would be a more precise entry. Another thing that might happen is the appearance of an outside candle, which is exactly the opposite of an inside candle. In other words, the total range of the outside candle completely engulfs the range of the immediately previous candle. If in this case we have an outside bullish candle after our inside candle, we would have yet another indication to pull the trigger. You could open the trade at the open of the next candle or wait to trigger the line. It's difficult to come up with exact rules of how you are supposed to trigger a trade because price always does something different, so it's hard to condense all the possibilities of price nuances in static rules. Another price action formation that can happen, and it does happen quite frequently in reversal points, is the fractal candle. If you are interested in learning what a fractal candle is, check out the Fractal Flow Strategy video course because that requires a longer explanation that has nothing to do with the market maker strategy. Let's summarize what you need to pay attention to while looking for opportunities to pull the trigger on your trades. First, you must be aware of which of the two triggering methods you will be using. The second thing is to observe how price will interact with the elements that you defined in the contextual part of the analysis like lines or zones. You must pay attention at how price touches and respects those levels, and also what types of candles appear. These 2 or 3 candles right before a trade being opened is almost like a micro-context on its own because there is a little story going on, and it must make sense according to market logic. You cannot pull the trigger after an inside candle just because I am telling you that this is okay to do. You must understand why this is valid, then you will have the confidence to do that without needing to trust what I say. You will need to trust yourself before trusting someone else. Needless to say at this point, but to trigger a trade you must have a predefined context, a stop-loss idea and a target idea. All of these elements must allow you to have the possibility of closing a successful trade with 1 to 3 risk-reward ratio most of the time.